On October 24, 1929, the floor of the New York Stock Exchange looked like a battlefield. Thousands of investors crowded the trading floor, paper orders flew through the air, and brokers shouted over one another as prices collapsed faster than anyone could process. Billions of dollars in market value vanished in just hours. Men who were millionaires the day before suddenly owed more money than they could ever repay. Some collapsed in panic. Others stared silently at the trading board as a sea of red washed over the entire market. History would remember this moment as Black Thursday. But the real mystery isn't just what happened that day. The real mystery is this. How did one of the most powerful financial markets in the world allow a bubble so enormous that its collapse would help trigger the worst economic crisis in modern history? To understand the crash of 1929, you have to go back to the roaring optimism of the 1920s. In the years after World War I, the United States experienced one of the fastest economic expansions in its history. Factories multiplied, automobiles rolled off assembly lines, and radio stations connected millions of households. Corporate profits soared. Between 1921 and 1929, the stock market became the ultimate symbol of American prosperity, and investors rushed in. Wall Street brokers saw a golden opportunity. For the first time in history, they made it possible for ordinary citizens to buy stocks using borrowed money. This practice was called buying on margin. Instead of paying the full price for shares, an investor could put down as little as 10% of the cost. A $1,000 stock purchase required only $100 in cash. The rest was financed through a loan from the brokerage. At first, the strategy looked brilliant. As stock prices rose, investors made enormous profits while using only a fraction of their own capital. A small investment could generate massive gains. Newspapers printed stories of office clerks turning into millionaires. Taxi drivers began offering stock tips. Even shoeshine boys were discussing market predictions. This was no longer just investing. It had become a national obsession. By 1928, speculation completely dominated the financial markets. Investment trusts formed across Wall Street, pooling capital from thousands of investors and using leverage to amplify their returns. Banks quietly funneled customer deposits into risky stock market loans. Institutional investors and wealth managers alike increased their exposure to stocks, all chasing those ever higher returns. The Dow Jones Industrial Average surged from around 100 points in 1924 to over 380 points. By September of 1929, investors believed the growth would never end. But beneath the surface, the financial system was becoming dangerously fragile. The entire market depended on one critical assumption. Stock prices had to keep rising, because if they stopped rising, margin investors would face a brutal reality. When you borrow money to invest, your broker requires you to maintain a certain value in your account, called a maintenance margin. If the value of your stocks falls too far, you must deposit more cash immediately. Otherwise, your broker sells your shares automatically. These forced liquidations are known as margin calls. And in 1929, the entire market was built on borrowed money. By late summer, the first signs of trouble appeared. Industrial production began to slow. Interest rates started rising as the Federal Reserve attempted to cool down all the speculation. Some experienced investors quietly began selling their stocks, recognizing the classic pattern of an asset bubble. But most investors ignored the warning signs. On September 3, 1929, the market reached its absolute peak. The Dow closed at 381. Then, the decline began. At first, it seemed like a routine correction. But as prices fell, margin calls began to ripple across brokerage accounts. Investors who had borrowed heavily suddenly faced demands for cash they did not have. Brokers began liquidating their positions. That selling triggered more selling. Fear spread like wildfire across Wall Street. On October 24th, panic finally erupted. Black Thursday, the market opened with massive sell orders flooding the exchange. Prices collapsed. Institutional investors and banking leaders scrambled to stabilize the situation. A group of powerful financiers, led by Richard Whitney, tried to restore confidence by placing large buy orders for major stocks. For a moment, the strategy seemed to work. The market stabilized, but the underlying problem hadn't disappeared. There was still far too much leverage in the system. 5 days later, the panic returned with a vengeance. October 29th, Black Tuesday. 16 million shares were traded in a single day, a record that would stand for decades. Prices collapsed across nearly every major company. Fortunes built over years disappeared overnight. By mid-November, the market had lost nearly half its value. And the damage didn't stop there. The crash completely destroyed investor confidence. Banks that had extended loans to stock speculators suddenly faced massive losses. Credit tightened across the entire economy. Businesses struggled to get financing. Consumers stopped spending. Within 3 years, unemployment in the United States reached nearly 25%. What began as a stock market collapse spiraled into the Great Depression. But the real lesson of 1929 goes far beyond one market crash. It reveals a pattern that continues to shape financial markets, even today. The core problem wasn't simply falling prices. The problem was leverage, combined with speculative psychology. Leverage amplifies both gains and losses. When investors borrow money to increase their market exposure, returns can grow incredibly fast. But that same mechanism turns small declines into catastrophic collapses. The margin system of the 1920s created an environment where investors controlled huge portfolios with very little of their own capital, magnifying speculation across the entire market. Today, modern investors still face similar risks. Leverage exists in many forms across global financial markets. Hedge funds borrow capital to enhance returns. Private equity firms use debt to finance acquisitions. Real estate investors rely on mortgages to control large assets. Even modern trading platforms allow investors to speculate using derivatives and margin accounts. At the institutional level, portfolio managers constantly balance risk management, asset allocation, and capital preservation. Wealth managers emphasize diversification and long-term investing strategies, specifically to avoid the kind of catastrophic losses seen during speculative bubbles. But history shows that during periods of rapid growth, investors often forget these principles. When profits appear easy, risk management tends to disappear. Speculation replaces disciplined investment strategy. The same psychological forces that drove the 1929 bubble continue to appear in markets today. Think about the dot-com boom of the late 1990s, the housing bubble before the 2008 financial crisis, the cryptocurrency speculation cycles of the 2020s. Each era follows a similar pattern: excitement, rapid price growth, leverage, and then panic. Understanding these cycles is one of the most valuable lessons in financial history. Because successful investors aren't just the ones who find profitable opportunities. They are the ones who survive when the speculation collapses. The investors who avoided the worst losses in 1929 weren't the ones chasing quick fortunes. They were the disciplined ones, the ones who managed risk, the ones who refused to believe that markets could only move in one direction. And that raises an uncomfortable question for all of us. If you had been investing during the roaring 1920s, watching fortunes grow all around you, hearing stories of ordinary people becoming millionaires, would you have followed a careful, long-term investment strategy? Or would you have joined the speculation, believing the boom would last forever? Thanks for watching. Be sure to subscribe for more stories from financial history.